Hey there, today, we're diving into the Canada will be considered residents for tax purposes. As such, they will receive a social insurance number, SIN, and will need to file income taxes with the Canada Revenue Agency, CRA, each year. This guide outlines key capital gains tax exemptions that newcomers can use to legally lower their tax burden. Important note, Canadian tax laws are complex, and this article simplifies certain concepts. The information provided here should not be taken as financial or tax advice. It's crucial for newcomers to consult with reputable and experienced tax professionals before making any decisions based on these strategies. Principal residence exemption. When you sell or dispose of a capital asset, including your home, you generally have to pay capital gains tax. This means you pay income tax at your marginal tax rate on the taxable portion of the capital gain. A capital gain is calculated by subtracting the asset's adjusted cost base, ACB, the price you paid for it, minus depreciation and plus any capital expenditures, from the amount you sold it for or its fair market value. For instance, if you bought a rental property for $50,000 and sold it for $250,000, your capital gain would be $200,000. With the current capital gains inclusion rate of 50% for individuals, for gains less than $250,000, you would owe income tax on $100,000. At a 50% marginal tax rate, that would result in $50,000 in taxes owed. However, Canadian tax laws offer an exemption on capital gains for the sale or disposal of a principal residence. If you've lived in your principal residence for the entire time you've owned it and qualify for the exemption, you typically won't owe any income taxes when you sell or dispose of your home. The gains from the sale of your principal residence are usually tax-free, provided it has been your principal residence the entire time you've owned it. To qualify as a principal residence, a property must meet specific criteria, and you must declare it as such each year on your tax return. Lifetime capital gains exemption. Canadian tax law also provides a lifetime capital gains exemption for gains made from selling or disposing of qualified property. Qualified property includes Qualified Small Business Corporation shares, QSBCS, Qualified Farm or Fishing Property, QFFP, reserves and trusts of the above. Each taxpayer may use this lifetime capital gains exemption if they qualify. For 2023, the lifetime capital gains exemption is $971,190. If an individual fully utilizes this exemption, their taxable income would be reduced by $485,595, half of the capital gains exemption. If the individual is in the 50% marginal tax bracket, this could save them over $200,000 in income taxes. Non-residents are not eligible. To claim the lifetime capital gains deduction, you must be a resident of Canada for tax purposes when you dispose of the property. Determining if you're a resident of Canada for tax purposes. The CRA considers several factors to determine tax residency, such as the amount of time you spend in Canada, whether you own a home in Canada, whether you have a spouse, common law partner, or dependents in Canada, whether you have personal property or economic ties in Canada, whether you have Canadian health insurance, whether you hold Canadian government identification. Even if you have left Canada, you might still be considered a factual resident of Canada if you maintain significant residential ties. For more detailed guidance, individuals can refer to Income Tax Folio, S5F1C1, determining an individual's residence status, or contact the CRA directly at 1-800-959-8281 within Canada and the United States, or 613-940-8495 from outside Canada and the United States. Don't forget to like, share, and subscribe for more tips.